How to Manage Personal Finances book, Chapter 12, Crushing Life Goals and Bond Investing. This is Ken Boyd. So as an author's note, I'm posting text versions of this entire book on Substack, which is what you see here, and video versions that you're watching on a YouTube playlist. You can email me for details on my fifth book's publishing date in late 24, early 25. So based on what I see on social media, hundreds of people are crushing life's goals. So here's a typical comment. I sold my startup business for an 8-figure exit price. I lost 50 pounds. I went to Burning Man and I lived with my soulmate. You may be asked to read a thread, attend a course, or join an online community to find out how you too can crush life. The trouble is that most people aren't crushing life. We all struggle, make mistakes, and we learn from the experience. And I think this is true for most investors. So you read earlier that there are two ways companies raise money to operate the business. They issue stock or issue bonds. I'm going to keep it that simple for now. I'll assume that Sally, who's our investor in the book, can invest in using stocks or bonds or both. In chapters 9, 10, and 11, I introduced the basics of common stock investing. Now let's talk about bond investing. So some basics. Corporations, municipalities like cities, states, and the federal government can issue bonds. Here are some bond terms that you need to know. The issuer, let's assume that IBM is issuing a corporate bond. They're the issuer. Face amount or par amount is the amount that IBM must repay bondholders when the bond matures. This dollar amount is also referred to as the principal amount. It's like the principal on a personal loan. Maturity date, the date that IBM must repay bondholder. Coupon rate is the interest rate used to calculate interest payments, and that is stated on the bond certificate. And finally, a bond rating is a letter rating that ranks the creditworthiness of the issuer. In other words, how likely is it that IBM will pay all the interest and principal payments on time? So there's a ranking. Standard & Poor's, S&P, ranks bonds from AAA highest to D lowest. Ds are actually in default, not being paid. Investment grade bonds are rated from AAA down to BBB, and most investment advisors only recommend investment grade bonds and stay away from lower rate things that are more risky. Understanding bond prices and bond yields. Bonds trade in the marketplace just like stocks, and the price of a bond can change, and a lot of people don't understand this concept. Let's assume IBM issues a AA rated, highly rated, $5,000, 6% bond, matures in 10 years, at par or $5,000. Each year, the investor earns 6% on $5,000 or $300, and importantly, that $300 payment never changes for the 10 years that the bond is outstanding. It doesn't matter what the price is, what it's bought or sold for. That's a fixed amount, $300 a year. Now, let's assume that interest rates increase. If comparable corporate bonds, say another bond with a AA rating, can issue a bond at 8%, the comparable 6% IBM bond will decline in value. So why is that? Well, because investors can buy the new bond at 8%, the 6% bond is worth less. Let's say it's only worth $4,800 to investors in the marketplace. Bonds total return. So then why would someone buy a 6% bond if new bonds of similar quality are being issued at 8%? Why bother? Well, if the buyer can pay a discount, the 6% purchase might make sense, which brings us to a bond's total return. A bond's total return, also called yield to maturity, is the interest income plus any gain or loss that you earn on the bond when it matures. If an investor buys the $5,000 IBM 6% bond for $4,800, the total return is two things. The $300 annual interest payments plus there's a gain. The difference between the $4,800 cost and the $5,000 received at maturity is a $200 gain. So you have two components of your total return on the bond. When you speak to investor advisors about a bond, ask about the bond's total return. They'll list it as yield to maturity. For simplicity, I'm going to call it total return. And finally, bonds may offer more predictability than stocks. The IBM bondholder can buy the bond, hold it to maturity, and know the annual interest payments they'll get, the principal payment they'll receive at the end. They'll get $300 a year in interest, repaid $5,000 at the end. That assumes that IBM maintains a good credit rating. So there's some predictability to bonds that we don't have for stocks. So that's as far as we'll get right now. Remember that you can find all the chapters here on Substack and on the YouTube playlist. Thanks for watching.